Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. Today we are going back in history to compare and contrast today's market environment that we've had over the last 20 years to the market environment we had leading up to the Great Depression in the 1920s. Now you can argue that we have a very similar setup, and let me make my case here. During the First World War and a few years after, we had two big bear markets, two big recessions, the second one being close to a collapse of the financial system in the early 20s, where you did have a brief period of deflation during that recession. And following this secular bear market that we had leading up to 1922, we saw a big boom that then led to a very stable period where inflation, right, this is the chart of inflation, stayed relatively stable between around 0 and 2%, which led to a period of very easy monetary policy where both the economy and the financial system were able to leverage up. Today, if we look at the SP 500 and we try and make a fair comparison, well, we have two big recessions, two big bear markets, the second one being close to a collapse of the financial system, with a brief period of deflation, which then led to a period of price stability with very low inflation, where monetary policy was very easy and financial system were able to leverage up throughout the last decade, with interest rates being lower than they've ever been, with access to credit being as easy as it ever was. So many people are concerned that this is just another Great Depression that's waiting to happen. And with the yield curve that recently inverted here, many investors are waiting for the market to head a lot lower imminently, because yield curve inversions are a predictor of recessions, right? In 2008, the inversion predicted the crash. In 2000, the yield curve predicted the crash. So why would it be any different this time? So that is exactly what we're going to take a look at today. We're going to go over some very interesting charts that hopefully are going to make you a more informed investor. If you do enjoy this video, don't forget to smash the like button, because it does really help push these videos out to more people. And of course, subscribe to the channel if you haven't already. Before I start digging deep into this video, I want to make a quick announcement that we are extending the Black Friday Cyber Monday deal because of how much traction we got on this discount and the fact that we're not going to be doing this until the next Black Friday a year from now. Well, we wanted to give an extra chance to people who haven't been able to take advantage of the membership yet. So if you are interested in our service, make sure to grab yourself a membership by using the link in the description below. I won't go through the details of the service now, it's described on the website, but I'm positive that you guys will love it as well. So where I want to start off in this video is by looking at yield curve inversions, because yield curve inversions are one of the most accurate recessionary signals from the financial markets. Somehow the yield curve even predicted the COVID recession. Don't ask me how the bond market saw that one coming. So what we want to do, if we really want to compare the 1920s to today fairly, well, we have to look at the yield curve leading up to the Great Depression. So there's not much data on the yield curve going back to the 1920s, but this is a chart that I was able to find. It's the 10-year minus the 3-month yield curve. So the same yield curve that has just inverted in the second half of 2022. So if I put a vertical line at around the 0 line here, and we skip this brief inversion right there, and we use this one, well, you can see that the yield curve leading up to the Great Depression inverted in December of 1927. So even during the two periods where the financial system was probably the most fragile, 2007 and 1928, the yield curve inversion was around 2 years early. Now, why did that happen? Why was there this lag leading up to the market top? That's a big question, and should we expect that to happen again? That's what I'm going to be answering right now. Now, really, the big answer lies in the unemployment rate, right? If we go back to the unemployment rate during the Great Depression, and again, there's limited data on this, and you can see the data set only starts in April of 2009, but you can see leading up to the market top in September of 1929, it was low. The unemployment rate was hovering between around 1 to 2%, and it wasn't until October of 1929 that you really started to see the unemployment rate rise and that is when the stock market decline began. So in other words, despite the fact that the yield curve had inverted in December of 1927, it took 2 full years before the unemployment rate began to rise and the stock market started to price in the Great Depression. So the economy stayed resilient to that yield curve inversion for around 2 years before the economy went on a complete free fall. Now, what's the key lesson here that I really want to come across with is that even though the economy was extremely fragile leading up to 1929, even though the financial system was on the brink of a collapse, it was levered up both in terms of the stock market and the economy. The yield curve inversion did not lead to an immediate collapse of the stock market or the economy, and the stock market didn't collapse until the unemployment rate began to rise. And you can say the same thing about 2008. With hindsight, both the economy in 2006, 2007, and the financial markets were extremely vulnerable to a deleveraging. We had an overextended credit system, a very weak consumer, an overleveraged banking system, and yet between the moment that the yield curve inverted, which was July of 2006, that the unemployment rate here in blue started to trend up, that was really in October of 2007. And again, that's when the market topped. So even though the economy was extremely fragile, it took over a year between the yield curve inversion and the beginning of the unemployment rate rise. It took over a year between the yield curve inversion and the moment that the economy began to weaken and the financial system began to collapse. So if we look at the unemployment rate today, well, it's still low. Yes, we have the yield curve inversion. Yes, we are hearing anecdotal evidence of companies, especially tech companies, laying off employees, but there is no data to back that up. And you can make the case, actually, that because the labor participation rate is so low following COVID, we had a big collapse in the number of people that have actually been looking for a job. Well, perhaps that means that the unemployment rate is going to stay low for a lot longer than some people are anticipating. This video really is aimed to help you open your mind up to different possibilities, give you some historical context, give you an understanding of how these relationships work together, how these indicators work with one another, and what type of lags you can have between certain signals. If you did enjoy this video, don't forget to smash that like button. It is really appreciated. Now, in the meantime, I wish you good luck on your trading and see you next time.